Howdy, Jacob here. Today we're looking at National Research Corporation in the healthcare provider and services industry. 800 million market cap, slightly higher enterprise value. So slightly smaller company. I want to look at insider ownership, and we see 37% held by insiders. That's fantastic. That means that you can be more confident as a shareholder that they're going to do what's in the best interest of you as the shareholder, as they themselves are invested quite a bit into the company. So what that means is insiders could be anyone on the board or anyone in management, upper management, who maybe there's a private equity firm that owns it, but they own 50% of the private equity, whatever. That's what that means. So great insider ownership is a positive sign, not necessarily uh, something to sway good investment versus bad investment, but just one of the statistical things to look at that can definitely be a plus, and that is a plus. Fairly small growth on revenue, but we are seeing very consistent mid-single digit revenue growth outside of last year where it was negative. Great gross margins at 60% and increasing the last 10 years. Operating margins actually down from 10 years ago, but was up in the early 2020s. So it looks like just this year, maybe selling in general and admin went up a bit. But I do like to see earnings per share is up quite a bit more than revenue. That's positive. That's a good sign. I mean, the company is becoming more efficient. Dividends are up quite a bit. Return on invested capital is also up and fantastic, 30%. That's great. I do have to say that founded in 1981. I do have to say that when you do buy back shares, that does inflate your return on invested capital, and so artificially. And so keep that in mind. It looks like this company does repurchase a little bit of shares, so that can inflate your return on invested capital figure, especially founded in 1981 if they've done that. They haven't done that consistently, but if you've done a good amount, then it does inflate your figure. So keep that in mind. 7 million cash on hand with 29 million long-term debt, 7 million short-term debt. In relation to that 5-year average free cash flow, we're looking at less than a year to pay down that debt. So no concern on the debt side. Use of cash is really a small acquisition here, but essentially all just share repurchases and paying a dividend. Currently, that dividend of 36 million is paying, even on a 5-year average basis, about 90% of their free cash flow. And this year was actually greater than the amounts they had to go into debt, because again, there's only two ways to fund a loss. You can either just use the cash that you have on hand, or you could issue shares, issue debt, and it looks like they issued debt here to fund their share repurchases as well as dividend payout due to their free cash flow not being great enough to substantial the both. So due to the free cash flow not being great enough to be able to pay for both of them. And so if we're making an assumption, my first one is going to be cut that dividend in half. We're now looking at 40 to 45% payout ratio, which is what I would want for this type of company. And then share repurchases with stock-based compensation, about 10 million would be about 1%, and that still leaves. So we cut this in half, 18 million. This is about 10 million, so we're looking at 28 million in relation to the 5-year average free cash flow. That's about 60 to 70%. I think I'm comfortable with that. That's basically saying that 30 to 40% is left over to make acquisitions that make sense, reduce debt if there's nothing else to do, or you get over leverage or something, and then reinvest back into yourself since you have a historical high rate of return in your invested capital. And then other assumptions on the revenue growth side, I think 4% seems to make sense to me based on history. 16, so pretty much in line with the market, maybe slightly higher due to their possibility of having higher returns of invested capital. 23, 22 on the margin side, and it still needs to fall 61% before you get the return we're looking for here. Again, the assumptions are based on what they're doing with this cash flow. So we're saying that about 45% of cash is going towards a dividend, maybe 20% is going towards share repurchases, and that remaining 30 to 35% is going towards acquisitions, reinvestment to get these type of figures, that revenue growth number, that margin figure, and then based on at the end of 7 years, them having the capability to possibly reinvest at high rates of return gives them an advantage over the average company. But again, from price perspective, still looks a bit frothy here. So hopefully you enjoy the video and have a great rest of your day. Thank you.